Good afternoon, everyone. You're most welcome to this RSM webinar, focusing this afternoon on some of the key taxes that are impacting individuals and families. I'm Gary Heynes. I'm Head of Private Client Services for RSM, and I'll be your host for the discussion that we'll have today. Very timely to this webinar, I saw earlier this week a report from the Resolution Foundation around the change in wealth in the UK over the past year. Due to asset growth, reduction in personal debt, increased savings in parts of our society, and they suggest that collective household wealth has increased by a staggering £900 billion. It may well be on the government's agenda to capture some of that increase in household wealth to recover some of the 200 billion spent so far on the pandemic. Conveniently, that is a large part of our topic of discussion today. Taxes which are applied to growth in capital being mainly capital gains and inheritance tax. So I'm delighted to be joined today by Bill Dodwell, who is Tax Director at the Office of Tax Simplification. Bill took on this role at the OTS around 3 years ago after a long and impressive career in tax with one of the big four accounting firms in a technical role overseeing their tax policy. Welcome, Bill.
Thank you very much indeed. I'm delighted to join the call and, hello to the audience.
I'm also joined by two RSM private client tax partners, Elaine Shields, who is based in Birmingham. She advises a range of individuals and families in relation to their wealth and tax issues. Welcome, Elaine.
Thank you. Good afternoon, everyone.
And Chris Etherington, also private client tax partner based in Leeds. He advises a range of entrepreneurs and family businesses and can also be found quite regularly in the broadsheets advising on commenting on tax issues on behalf of RSM. Welcome, Chris.
Thanks, Gary, and hello to everyone.
Before we start our discussion, just a reminder that you're most welcome to ask questions for our panel via the Q&A functionality, and we'll pick these up at the end of the session. Now, hopefully you can see the Q&A box. If you can't see it, you'll see at the bottom right of your screen next to the chat box, there are 3 dots that you can click on and you can add the Q&A box. Very welcome for you to add any questions, and we'll leave some time at the end to answer those at the end of our discussion. So our agenda for this afternoon, well, I think we should have a shorter introduction to the Office of Tax Simplification, and then we'll go through what the OTS has been doing in relation to inheritance tax and capital gains tax. We'll also touch on the digitization of our tax system and what that will mean for individual taxpayers actually starting in the very near future. And as I say, hopefully at the end, we'll have 10 or 15 minutes for questions that have been raised if we haven't answered them as we've gone through our discussion. So on to the next slide. Next slide, please, I think is the phrase. Question 1, I'll start with you, Bill. Perhaps you can give us an overview of the Office of Tax Simplification, which has got a name which I think leads to great expectations. Its purpose, how it interacts with government, and perhaps 1 or 2 changes that have come about since the OTS has been there.
Well, thank you very much. Very glad to do that. The thing from this slide really is a link to our website. One of the big things about the Office of Tax Simplification is we publish everything we do. You'll find it lurking there. Obviously, your favorite search engine may get you there quicker. The other thing I'd just like to mention is we really, really welcome your feedback. Whether that's you've come across a little problem that you think could be made better, or you've got an idea around a broader area where you think simplification would help, then please do send us an email, and our email address is ots@ots.gov.uk. So looking forward to hearing from you is all I would say. And the final thing that we always benefit from is people giving us comments in responses to our calls for evidence as we go through. Now, our next slide sort of tells you a little bit about the OTS. We started in 2010 as the independent advisor to government on tax simplification. And that means we're not a think tank. We're paid by the Treasury and HMRC, if you really want to know the answer to that. and our job is to be an advisor. So we do not implement, and that's again a really important point, because I think the way democracy in the UK works is that it's a role for government to choose to implement tax legislation, and obviously the tax authority, Her Majesty's Revenue and Customs, to deal with the administration of all of that. So part of our role is influencing and advising, encouraging, if you like, through all of that. We were given statutory authority in 2016, so we're formally set up. We obviously, the law can abolish us in due course, but we can't just disappear overnight, if you like, because it would need a change of law. We work as a mixture of public and private sector people. So I'm obviously, as Gary mentioned, from long-term working in the private sector. And working in tax, but our head of office, David Halsey, is long-term HMRC, and our team is just a mixture of, it's probably more private sector people rather than HMRC or Treasury, but it's that sort of interface and interplay, if you like, that we can do that I hope sort of helps us come up with better recommendations, things that actually are capable of landing, as you might put it, with the Treasury and with HMRC, and things that reflect the day-to-day frustrations of taxpayers and their advisors in trying to navigate through the tax system. We have an independent board. It's chaired by Catherine Kearns, who is a financial accountant. I think she's an auditor of the International Monetary Fund, amongst her other roles. So interesting sort of person. And we've got 4 independent directors, board members, whatever, if you like, sitting, including Professor Judith Friedman, Paul Aplin, John Cullinane from the Chartered Institute of Taxation, and Kathleen Russ, who is senior partner at Travers Smith, the law firm. You can read what we do with our annual report. We're just about to publish our next one next Monday, I hope, so you'll find that lurking on our website. And there were. And the final thing just to say is that the legislation introduced has provided for a 5-year review, and so that's currently going on at the moment. The call for evidence has just closed, and the Treasury will be publishing their review, I imagine, before budget, whenever that turns out to be later this autumn.
Great, thank you, Bill. That's a really good overview of the OTS. It's certainly from my perspective a really important organisation within the machinery of government and creation of tax policy. So thank you for that overview. I'm going to stick with you for my next question. And obviously the OTS has been doing a number of tax reviews at the request of government. And I'd like to talk a little bit about the recent reviews that they've carried out in relation to both inheritance tax and capital gains tax. But in 2019, if I do it in chronological order, the government asked the OTS to review and suggest changes to simplify the inheritance tax rules. And perhaps you can give us an overview of that review and some of the key recommendations that the OTS made.
Yes, of course, and I ought just to have said that we do 2 types of review, those requested by the Chancellor, which are these 2, and reviews we do on our own initiative, if you like, where we do agree the terms of what we're going to look at with the Treasury and the Revenue, really to make sure that we've got something that they're interested in landing properly. Now let's start with inheritance tax. We decided to split the review into 2. I wasn't involved in the first report, which was all about tax administration, and our slide sort of starts to take us through it on the next slide. So that was published really as we're kicking off with suddenly capital gains tax, I think. So we've managed to switch our order of events, which is just fine. Anyway, let me just go back to the story. We started with inheritance tax. Yeah. We started with inheritance tax, and we published the first one about the administration of the tax, and the second report was all about policy principles of the tax and how we could simplify some of those, and also look at behavioural distortions. And for us, the Chancellor has on a number of occasions said, please look at behavioural distortions. And what that means is when people do something for tax purposes, You know, the moment you hear that sort of phrase, it tells you there's behavioral distortion, because you're doing something in a different way or at a different time to what you would normally do for the purpose of your business or your family issues, all that sort of stuff. So shall we move on to the slides? Let's see if we can start.
I think we took out the inheritance tax slides, Bill, so we've only got the CGT. So let's stick with IHT and we'll come back to the CGT question.
Okay, the first thing was really, can we digitize the inheritance tax system? And the answer is yes, we can. And that's going to start from 2022. And that's really good news. And anybody who's had to engage with that system during the pandemic will have discovered that, you know, actually HMRC have introduced a number of easements, if you like, to try and enhance the sort of digital side of things. And that really is good news. Now, why didn't it happen earlier? The answer is simply that there are only about 25,000 estates that pay capital gains tax. Currently, about 275,000 estates actually send in a return, and that number is going to be substantially reduced as part of the reforms from next year. So it wasn't it's not a system like income tax, of course, which affects, there are over 31 million income taxpayers. So that's why it was a smaller scale. Now, on the policy side, we essentially we tried to put things in pots, if you like. So we grouped stuff together. One was to reduce that famous 7-year limit down to 5 years. Why did we do that? The reason was that people don't have records for 7 years. Banks keep stuff for up to 6. And if you're the executor and you've got to find out what's happened in the last 7 years, it can be really, really difficult to do that. And things sometimes occasionally crop up, 3 years after the person died and all that sort of stuff, which makes the life as an executor really quite hard and challenging when it comes to finalising the estate and distributing it. So we proposed reducing that period to 5 years. Now, that was going to cost money. Because obviously people do give things away, and reducing that period before the so-called nil rate ban reinstates itself was clearly going to cost money. And we thought, well, let's partly pay for that by abolishing taper relief. Now, taper relief is a relief, and the reason we said that, again, not only just to raise money, but we've found in practice that virtually nobody, apart from an inheritance tax expert, understands how it works. Everyone thinks that if you give something away, the value of the gift is chopped down a bit. No, that's not what actually happens. If there were tax to pay on a lifetime gift, then it's the tax that's actually reduced. So we said, let's sort of deal with that by simplifying, ditching something completely and nobody follows, and at the same time giving a 5-year benefit. The other one we sort of said is we need to look at the reliefs for giving. There's you can give £3,000 away tax-free as free of inheritance tax, as many people may or may not know. Fewer know that than the 7-year rule, I think it's fair to say. And it's also not been adjusted for inflation. So we said, and there are other, small gift rates. There's gifts on occasion of marriage and all this stuff. So we said, why don't we just put them all into one and uprate it to a figure. We didn't actually recommend a figure, but inflation would have taken it to about £11,000 tax-free. And we just thought it would just make all life much more straightforward. When grandparents give stuff away, nobody's actually got to count it up very much unless it's big. And then, of course, it's relatively easy to spot and count generally. And there's another relief called, normal expenditure out of income. And the theory is you've earned the income, you pay the tax on it. Shouldn't you just be able to give it away without triggering inheritance tax? And that's fair enough, but the way it works is really complicated and normal people don't understand it. And you only really manage to claim it if you've got an advisor who is telling you every year what you need to do and how you need to do it. That's not the way the tax system should work. I've spent my life as an advisor, so I'm certainly not against advisors at all. But, we need our systems to be a bit more intuitive and not require an advisor at every sort of step of the way. So we said the government either needs to abolish it and instead inflate that £11,000 up to something bigger, or alternatively, it needs to simplify how it works. And we didn't say which was the best answer. We just sort of left all of that. And then the final sort of big thing I just want to draw your attention to is the fact that where you get an inheritance tax relief, you might also get a capital gains tax relief. And so I'm thinking, for example, that you know, parent owns the family business or the family farm, and they hang on to it until they die, and the business or the farm goes to the children, and there is an inheritance tax exemption, business property relief or agricultural property relief. And there is also a sort of market value uplift for capital gains tax, which means that the children take ownership of the business or the farm at the market value when the parent died. And that means that, you know, immediately after receiving all of that, they could sell the business or the farm if they wanted to, and they would have all the money tax-free. And it seemed to us that wasn't meeting the government's policy intent, which is that businesses or farms should be capable of being passed from one generation down to another, and operated by the second generation rather than being turned into cash. So we said, you know, this is mistargeted. You should, and yeah, there's various ways of approaching it. We simply said for it was probably best for capital gains if it went at the original cost to the parent, which would be a little bit of administrative tracking back, but at least would ensure that if you sold it, you'd pay some tax. If, of course, the children hang on to it and operate the business or farm, there's no tax to pay at all. So we said all of that. And then there's some detailed things about, you know, business property relief and how that should work, essentially asking for it to be made a bit easier to work out the definitions and some of the structures and that sort of thing.
Yeah, thanks, but I mean, it was quite a sweeping review, I felt, and there was lots of small things in there, but some really big, thoughtful things, such as you know, changes around the uplift on death. And you're absolutely right. I think inheritance tax is probably one of those areas that is quite niche in who actually knows about how all the rules work and all the reliefs which are available. You mentioned two things that, well, you mentioned three things. You mentioned the small 3,000 relief, which some may or may not know about, but the two big ones, which are, most people know that if they wait 7 years after making a gift, it drops out of inheritance tax, and the regular gifts out of income. So I'm going to ask Elaine, who deals with you know, a lot of wealthy families, what do you think about the OTS recommendations on these points?
Thanks very much, Gary, and thanks, Bill. That's a really good summary. I mean, I completely agree with the OTS recommendations. That there's such a myriad of small exemptions, and many of our clients do ask us, well, what can we give? And you know, we talk about if your daughter's getting married, if your granddaughter's getting married, it's all different types of exemptions. So far easier to move to an annual exemption to make that easier for people to deal with, and hopefully to encourage that generational giving as well. So yeah, completely agree with the recommendations.
And Chris, Bill also touched on release of business property, you know, which effectively exempts assets from inheritance tax or business assets, but they're both available to the hardworking business owner as well as the passive investor. And, you know, what do you think about the OTS recommendations around those business reliefs and farming reliefs, I should say, as well?
Thanks, Gary. Yeah, whenever there's talk of IHT reform, I think one of the topics that always comes up with clients is, will there be any changes to business property relief, which is that relief in particular that gives you 100% relief, or can give you up to 100% relief from inheritance tax on say shares in a trading business. Now, is it going to get scrapped? Will my shares continue to qualify? I mean, to be fair, the concern's pretty understandable. I mean, IHT, it came out in the OTS report, actually, it's such an emotive and unloved tax, really. You know, the prospect of having to wind up or break up a business following the death of a shareholder just to fund an IHT bill. Well, I think from my experience, clients would just be up in arms about that because they don't like it anyway. So, you know, broadly, the reliefs for business property are there, and they're really valuable as a result, because for that very reason. You know, as you've alluded to, Gary, there, I mean, the relief can extend to passive investors as well as, you know, the actual entrepreneurs and business owners themselves. So in particular, those investing into AIM listed shares on the AIM market. So an individual can invest into AIM listed portfolio of shares and still potentially benefit from 100% relief from IHT. Now, when any changes are suggested to that specific relief, I seem to get a lot of financial advisors and their clients hot under the collar, giving me calls asking what's going to be happening. And I'm sure Bill will correct me if I'm wrong on this, but I'm pretty sure the OTS's review didn't actually make any firm recommendations on that point at all. I mean, it's probably more a pointed observation that if you were to have an investor into an AIM listed company die, then you probably wouldn't need to break up that AIM listed company, and therefore does it really meet the policy brief for having that IHT relief in the first place? Well, I guess the case for the defence, AIM companies are risky. There's been some pretty high, I won't name names, but pretty high profile difficulties with a few of them in recent years. And I'm no stock market expert, far from it. Please don't take any investment advice from me. But I'd suggest that IHT relief has resulted in quite a lot of investment into that market. So what happens if you take that relief away? Well, there's obviously going to be an economic impact there, and I suspect a bit of a sharp correction in the market. So, as I say, that I think I'm actually commenting on something that wasn't actually an OTS recommendation. So I've not actually answered your question at all, Gary. It's a politician's approach. I've answered the question I wanted to answer.
Absolutely. Thank you.
Well, that was brilliant, though. And it's exactly right. We made an observation and we suggested the government needed to work out what the policy objective was in relation to AIM shares. We did not recommend it be abolished.
Yeah, good. Thank you. And we could spend an age talking about the inheritance tax review, and it is a very emotive subject, but time doesn't permit us to spend too long on that. I'd like to move on actually to the other capital taxes, which is perhaps much more common and much more aware, even though in the scheme of things it probably isn't paid by that many people. In 2020, so a year later, the government asked the OTS to review capital gains tax, and like IHT, again, the OTS made some recommendations, and the most recent of which was only in May this year, your second report. Perhaps you can give an overview of that review, Bill.
Yes, well, thank you very much.
And we have some slides as well.
We do have some slides. Sorry about that.
That's right.
My mistake on the inheritance tax. What we decided to do when the Chancellor wrote to us in July last year was that we would look at the policy principles underlying capital gains tax and do our first report around that. And then the second report, which came out in May this year, was going to look in detail at specific areas of capital gains tax more generally. Now, let's move on to our first slide. What essentially we said was that if the Chancellor is concerned that the disparity in income tax rates and capital gains rates, so potentially 45% income tax versus 20, or maybe in some cases 28% capital gains tax, if the Chancellor is concerned that this is leading people down a particular path, then he's really got two choices there. The first one is, of course, to align capital gains tax rates with income tax rates. And the second option for the Chancellor is not to align the rates, but to look harder at the boundary between income tax and capital gains tax and make sure that he's happy with what is subject to capital gains tax and doesn't believe it should be subject to income tax. And so we looked at a couple of areas in there where we thought that the boundary was unclear, let's just say. And were worthy of look, and those two areas were around certain aspects of employee shares. We did not examine the government approved share schemes, but we did look at cases where employees ended up in the company potentially getting a value that was greater to them because they were employees compared to the value received by financial investors in the same company. And we said there was a case for looking at that and seeing whether we've got the boundary right and whether that should be subject to capital gains tax, or indeed there was an income tax element in all of that. And the other situation we looked at was the retention of earnings in the company. And we're talking, we're specifically talking about small companies here, definitely not medium or large or anything like that, and certainly not a quoted company. But it is possible for me to set up Bill Dodwell Limited that charges my fees for speaking on seminars and that sort of thing, and I just keep all the money in the company, and then eventually I liquidate it and receive it as a capital gain. And actually it's sort of labor income that probably should be taxed as income. And so we said there was a case for looking at that, and whether on the disposal of a company we should end up taxing part of that to income tax rather than capital gains tax. And again, on disposal, not as it accrued and that sort of thing. Now, back to the, if the Chancellor was minded to align the rates, then there were a whole series of other things to consider. First is, we'd be taxing inflation as part of that. Now, you can argue a lower rate sort of gives a rough and ready relief for inflation. But if you're not giving a low rate, then you need to think about relief for inflation, and the fact that again is rolled up over can be rolled up over quite some time, and think about all of that. There are also issues around for wealthier people. Would they start putting their investments into a company to benefit from, well, currently 19%, potentially 25% fairly soon rate, but which is materially lower than income tax rates at 45, and look at all of that. So that's our first slide. If we've got a second. Mm-hmm. I love this one. This shows what happened. This goes back to the annual exempt amount when it was 11,300 a couple of years ago, or 3 years ago, sorry. And the reason why it's 3 years ago is because this is the year for which you got all the data relevant. And this is the spike in the number of people who realize gains just underneath that 11,300 threshold. And so the question for the Chancellor, again, it's not it's not saying you should do this. It's a question for the Chancellor. Why have we got an annual exempt amount? Is it there to for administrative reasons to keep really small gains out of charge to tax? And there's another graph in the report, if you look at it, which shows that if it's for administrative reasons, then the right sort of level is probably somewhere in the sort of £2,000 to £5,000 limit, possibly around £4,000 to deal with that. Now, the Chancellor may well have an entirely different objective for the rest of it, and that's not for us to determine as technical tax advisors, but that was where we sort of came on all of that. And then there's a whole range of other recommendations, including developing the one about gifts on death. And then we were trying to look more at neutrality, because at the moment, if you have an asset and you think, look, I'm a sort of age, it will be right for this asset to be owned by my children. But if you were to give it away today, unless of course it qualifies as a trading business and you get gift relief, but unless it does that, in many cases you'd have to pay capital gains tax on a gift to your children. And so what you're encouraged to do is hang on to it until you die, where it passes to the children with that market value base cost for capital gains. So you end up not paying the capital gains tax if it passes on death. And what we said was that this isn't a very neutral arrangement. We need to have consideration be given to a gift relief during lifetime, and consideration as well to not giving a sort of double benefit on death and removing that market value uplift and letting assets pass at the original cost of the deceased. And so if the children in my example sell them, they end up paying some tax. If they don't, they don't. So there we are.
No, thanks, Bill. And again, another very extensive report. I do like the slide that's on the screen at the moment, and so perhaps a couple of questions for Chris there. Question one is, to what extent do you think clients' behaviours are driven by CGT and income tax differential? So slightly different from the annual exempt amount, but the point that Bill made between where the border is, are behaviours between CGT and IT and income tax are driven by that. And perhaps a connected question, if I may, Chris, as well. You know, on business disposals, there has been a history of retirement relief, TOFA relief, entrepreneurs relief, and now business assets disposal relief. We've had lots of systems which allow business owners to sell at no tax in the past, or relatively low rate of tax. And again, you know, what do you think about the OTS recommendations in this area? And again, people's behaviours around their business assets.
Thanks, Gary. There's a few there to get through.
A couple of things to unpack.
I mean, in terms of a distortion, I think it's beyond doubt, to be honest. It's pretty clear from my experience that having a big difference in CGT rates at the main rate of 20 versus income tax rates at a top rate of 45 really can drive decision making, particularly with privately owned businesses. What I would say is I'm not actually convinced there's such a huge problem with that necessarily. I mean, the behaviours that I see being driven by that difference generally is that it makes more sense for the business owner to reinvest into their businesses rather than extract cash as they go along and de-risk. I don't actually, I mean, I'm sure it happens maybe with smaller businesses and consultancy business, but I don't see clients stockpiling cash in companies. You know, rather the incentives there for them to focus on building, growing businesses, take that longer term view, and ultimately benefit from that more favourable tax rate on exit. I mean, there's a lot of complaints about entrepreneurs relief when it was being mooted to be sliced and diced, and it eventually was. But the motivation at the outset for entrepreneurs almost certainly isn't driven by tax. But I think it becomes a larger factor as the business grows and becomes more established. So, you know, if the income tax rates and CGT rates were more closely aligned, it'd be interesting to see how that impacts and change people's mindsets. Would they be more inclined to take profits out of the business on an annual basis, say? I mean, from an investment view, again, I'm not a financial advisor, but if you were to speak to them and you said, right, I'm going to put all my life savings in one shareholding, they'd probably say you absolutely start raving bonkers, wouldn't they? You know, it's huge amount of risk involved in doing that, and the differential in tax rates arguably provides an incentive for entrepreneurs to continue reinvesting. I mean, the good news for clients, I think, who were concerned about a potential hike in CGT rates, I think the Chancellor's come to the conclusion that it's just not worth the hassle. There's a huge amount of political pain that would be involved in trying to win over his party and supporters. And yeah, it's not absolutely clear as how much additional tax revenues be generated even if he did do this. You know, ultimately, I think the OTS report, the first one, suggested maybe a 4.5 billion increase, but it's really difficult to predict. I mean, now ultimately CGTs, in one sense, a voluntary tax. You can ultimately sit on your assets and don't sell them. You know, so from my conversations with clients, the general consensus was they wouldn't like it. They tried to do everything they could to avoid it if they could, in terms of sitting on their assets, delaying sales, potentially moving overseas. The same thing that sort of conversation was not happening when the changes to entrepreneurs relief came through. Yeah, there was a lot of rumours about that having a big impact on the M&A market, for example, but we didn't see a departure lounge at the airports full of business owners. You know, people were disappointed by it, sure, but it hasn't slowed things down, and 20% is still a pretty attractive rate in the grand scheme of things when you look at it internationally. What we have been left with is a bit of a patchwork quilt of CGT reliefs. I mean, business asset disposal relief, you know, the relief formerly known as entrepreneurs relief, seems inordinately complex now for what is at best £100,000 tax saving per person. You know, there's definitely scope to simplify, perhaps just completely scrap, as the OTS has suggested, just go back to the drawing board, come up with something that was fit for purpose, because to be honest, it was brought in at pace originally back in 2008. And it was a bit of a knee-jerk U-turn reaction from Alistair Darling at the time. Then you got things like investors relief, which is kind of, you know, the ugly sister, if you like, to entrepreneurs relief that nobody really even knows about. Very few people have claimed it. It seems a bit bizarre that a passive investor can get 10 million of gains at 10%. Excuse me, whereas the entrepreneur who owns and creates the wealth for businesses only gets it 1 million at 10%. Yeah, it's a massive disparity there. And yeah, I'm kind of on board with the OTS's suggestion of just getting rid. So overall, I think taxpayers, yes, they can sort of perhaps sit easier in their seats around tax rate rises on CGT, but in terms of the reliefs on offer, I think they're just shrugging their shoulders at it, and that basically that suggests it's ripe for reform. Otherwise, what's the point of having them?
Yeah, I think, and a really important point. I mean, kind of connecting those two reviews. You talk about sitting on assets, to avoid the CGT. It's always a play between CGT and IHT, and I think, one tax. We often do the comparison, don't we, between what's the best way if you're going to gift assets, CGT now or IHT later. But both the IHT and CGT reports, Elaine, looked at the uplift in the base cost for assets and death, and Bill spoke about that. And under the current rules, and actually one of our questions that has come in, does it apply to investment assets too? But under the current rules, irrespective of whether you pay inheritance tax or not, the recipient gets an uplift in the base cost for CGT. So, it almost seems, I can see the point on business assets where there's no tax paid, but, investment assets where there is tax paid, should you also take on the original base cost? What do you think, Elaine, on the OTS recommendations?
Yeah, thanks, Gary. And it's a really interesting question. And as you say, it's where lots of different taxes and lots of different reliefs collide. And I think it's very useful that, as Bill talked about, looking at what can distort behaviours. And this is a classic example of that area where we're encouraging succession. We're encouraging businesses that want to transfer and pass on shares where they've maybe got their children in the business. And we're saying, well, you need to think about the tax. That's not right. But there would be winners and losers. So as Gary said, and let's take the example of an estate where maybe it's around that £1 million limit. Mom and dad have lived in the house all through their life, so there's no IHT to pay at the moment. We get the market value uplift for the capital gains tax. If they'd have sold, it would have been covered by private residence relief. So if we change that and we carry on with the base cost through to the children, do we need to give them an element of the private residence relief that the parents would have had? So an extremely complicated area, and one which lots of work needs to be done. But I agree, it needs to change, and government really needs to reflect on what behaviours they're trying to drive, and then make sure that the tax policy and the tax system wraps around that to work effectively.
And just for clarity, we recommended that people shouldn't effectively lose that main residence relief you just referred to. That would lead to another distortion. It'd be unfair. So we recommended that should be retained.
On main residence, actually, Bill, we've now got a system where on disposal of properties, and not necessarily main residence because they're exempt typically, you need to file within 30 days and pay some tax after you've completed your disposal. What is it? What do you think about this? Do you think we might be moving to a shorter time period for paying tax? Is 30 days too short a time? What's your view, briefly?
I think there's a couple of questions there. In general, I do think there is likely to be a move over time to reducing the gap between making the profit, earning the income, and paying the tax. And part of the logic is, if you're an employee, then you pay your tax every month when it gets locked off as pay as you earn. If you make a capital gain on selling some shares, you could easily not be paying the tax for more than 18 months after the event. And so that over time, I think there could easily be a trend of that, and the government is consulting on that in an issue called timely payments generally. The problem on the capital gains 30-day reporting, though, is that most people who make a capital gain do it only once in more than a decade. 70% of people with reporting a capital gain in a particular year didn't report any gains at all in the previous 11 years. And that means that there is a complete lack of awareness as to around what you have to do, when you have to do it, and that sort of thing. And so we recommended two options: either a longer period than 30 days, and we published some evidence, by the way, that showed that in the year in which this change came in, which is a year affected by COVID, so we shouldn't be shouldn't ignore that. But about a third of returns came in late in the information we had through to January. So we recommended either a longer period, 60 days, or a better means of making sure that taxpayers have information. And we suggested the government should look at conveyancers being required to give the equivalent of an HMRC leaflet to their customers to work out what they should really be doing.
Good. Thanks, Bill. Yeah, I do agree with you. I think 30 days, maybe 60 would be better, given the amount of information needed. So I appreciate your input on that. Actually, we're going to move on to another topic. I think we might just have a holding slide for this, but it's not one that the OTS has commented on. I mentioned the increase in household wealth at the start of this presentation, and over the course of the pandemic, very unevenly spread, of course, because it's down to asset price increases and the wealthy saving things that they were not able to spend. Now, I know you've not looked at a wealth tax, but we can't have a conversation about capital taxes and not mention it. This might be a quick answer. What is your view on wealth taxes? And the Wealth Tax Commission last year suggested maybe a one-off charge to capture some of this wealth that's built up would be the way to go.
Well, the OTS doesn't have an official view on a wealth tax because obviously one doesn't exist. The only thing I would draw your attention to, firstly, it's a really good piece of work by this Wealth Tax Commission, which is 2 academics and a barrister working away together with quite a large cast of supporting academics and former tax inspectors and that sort of thing. So I think they've done a really good piece of work and analysis around all of it. The problem, if you like, is that most people, if you ask, say, okay, I don't mind a wealth tax, but not for the family home and not for my pension. And the moment you take out those 2 things, you really, really restrict the number of people who might be liable to pay a wealth tax. Therefore, the amount of money it might raise goes down really, really significantly. So you end up with a lot of cost and administration. You end up with the potential for people, not to be in the UK so that their assets aren't subject to tax and that sort of thing. And you may not actually get as much money as you might have hoped. So it's more around the practicalities. And the other point I'd note is that our Chancellor seems to have ruled it out, but over to him,
which is quite an important point as well. Thank you for that. But I do agree, if you're going to introduce a new tax, the administration cost and burden of it needs to be worthwhile. So thank you for that. I am going to move on in the course of time to something slightly different from the taxes we've been talking about. So if we can have the next slide. Yeah. So for the last section of our discussion, for some time, the government's been moving to greater visibility. We touched on it a little bit as well about, whether payment of tax should be brought forward or not, and whether that would help. But we've seen real-time information from taxpayers under the banner of making tax digital. VAT, of course, employment tax, as you say, are paid very regularly. Self-assessment tax generally, and you mentioned CGT, can be paid up to 10 months after the end of the tax year. And I'm going to ask Elaine first, actually, on this. Can you bring us up to speed on the digitisation of income tax and where we currently are in this? And I'll come back to Bill in a moment for his view.
Yeah, thanks very much, Gary. So yeah, we've had the CGT reporting in for a year or so now, and I have to say it's not led the path, a positive path for the digitisation coming through. I think any individual that's been involved in the reporting, whether it be the individual or the advisor, have had a few headaches, and maybe Bill will also touch on the digitally excluded as well, which has caused a bit of a backlog with HMRC in dealing with paper returns. But moving on to income tax, well, we've had a moving horizon over the last few years, but it seems we are now on track that we will have making tax digital for income tax coming in from April 2023, so not long now. And we'll have a certain group of individuals that will fall into making tax digital from that point, and they will include the self-employed, landlords and partners in general partnerships. Now, the income threshold is really quite small. So the income threshold is £10,000 per annum, after which you fall into making tax digital, which mean you'll be submitting quarterly digital records to HMRC, reporting your income and expenditure on that particular area of income, and then topping up at year end. So as we touched on earlier, tax payments aren't changing, although we can see that potentially there'll be a voluntary payment coming through in over the years, but the quarterly reporting will add that additional compliance burden on for individuals, and interesting to see that limit at a low limit of 10,000, less than personal allowance. So someone earning less than personal allowance, not paying any tax, will still be required to submit records on a quarterly basis. So lots of help will be needed, and those people may not have tax advisors there to help them through it.
Yeah, thanks, Elaine. I think there's going to be a big shock to the system as we did. I remember when self-assessment came in. So it's another big change in the tax system, and something else we'll have to get used to, and clients will need to get used to when that comes in. It's not long to go. So making tax digital, that quarterly reporting for landlords and self-employed, is one part of the overall digitisation, I think, for HMRC. Bill, what's the bigger picture for HMRC and the bigger challenges that they have?
Well, let's move on to our next slide, because this is something that the OTS has been calling for since 2019, and it's featured in the tax administration strategy, which was launched by the government and HMRC last year in 2020. And the idea is that every taxpayer should have a single customer account. That's the name given to it. Essentially, it's an app or a website where you as an individual get to see all your data from HMRC, everything they reasonably know about you, and it's where you give HMRC information and make claims and change your address and all that sort of thing. We already have a limited version of this in the form of the personal tax account and the related but not really connected business tax account. But the point of the single customer account is to pick up absolutely everything, whether it's benefits or income, and we think capital gains should be in there as well, and allow the taxpayer to manage their tax and benefit affairs in a really joined up manner. We think if it's done well, we really hope it will be, and we're doing our best to encourage HMRC to do this, and obviously it'll need some funding to do so as well. But we think this will actually improve taxpayer trust by producing a lot more transparency around an individual's tax affairs generally. Now, one of the things that it should be powered by is third-party data. And I'm sorry about that ugly phrase. What I mean here is something like your bank interests, something like your listed company dividends, something like your pension contributions. And what happens at the moment is that us as taxpayers receive that information from our bank or our pension company and so on, and we then fill in a tax return or find some other means of telling HMRC about it, and that way we report our income, or we claim higher rate tax relief or pension contributions and gift aid and so on. To us at the OTS, it seems a much more straightforward way if, as well as us getting that information, the bank and the pension company also sent it straight off to HMRC. And that way it gets featured in that digital account. It'd be used for doing our tax code if we're a pay-as-you-earn person. It'd be used for filling in the data in your self-assessment tax return if you're doing that. It'd be available to tax agents so they could see what was in there of all of that. And we as taxpayers could look at it, understand what it is. We could say, no, this isn't me. This is me as a trustee for my child. This isn't my income. This is theirs, for example, and give that sort of information. We think this is a system that will come over time and ultimately will save taxpayers a lot of time, concern and worry, and indeed cost as well. And if it works well, properly as it should, then it'll also save agents some time and cost additionally in getting that sort of information. It needs to show everything in there. So, if you get state pension, it ought to feature in there. That doesn't currently feature in many people's personal tax account. As I say, your bank interest, obviously your pay-as-you-earn income as well. Plus, of course, the information you may have uploaded if you're a residential landlord or if you're a self-employed person generally. So that's how we very much see that working. The single customer record, by the way, is the sort of bit of background software that links all those sources within HMRC and produces it in a manner that can serve it up to all of us as customers in the single customer account. Now, let me just show my next slide, which is this is really a bit more about how we should take this vision for using that third-party data. We've just published a report about all of this. And how can we actually make this work better? The first thing is you've actually got to be able to know which Bill Dodwell you're talking about. You know, if you search Bill Dodwell, you'll discover that sometimes I'm doing wedding photographs in Oxfordshire. Only I'm not. So we need to be able to distinguish between all the individual people. And the most obvious identifier there is not our name, because there's lots of those. It's not necessarily our address, because sometimes we're all a bit dilatory in informing everybody of our current address. But it's almost certainly something like your national insurance number. And so we would like to see the use of that extended and mandated. It's obviously up to the government to do this, and the government might choose a different identifier and keep national insurance for something different. But the one that is most widespread and would be easiest to use is indeed the national insurance number. And if you just think about it in technology, something that says this is the unique code relevant to this individual, that's the way of ensuring the information comes in and ends up in my account and not yours. There's a lot of stuff that needs to come in. There needs to be a roadmap, there needs to be a data specification. We actually need to think about the balance of responsibilities. You know, what happens if there's a mistake, for example? And, you know, do we just rely on the computer, or should the taxpayers still retain overall responsibility for all of that? So we need to think about that. But this is a sort of list here of the data sources we're thinking about should go into the system. Really, just to make life easier for taxpayers overall.
Yeah, and I think it's going to be quite unique, because I don't think HMRC have interacted and pulled together that amount of third-party data, which is all very sensitive stuff for individuals, ever before. So we have to have some confidence, of course, that all of that systems and security and privacy works well.
Completely agree. And the only other point, I absolutely agree with all of that. The only other point I'd add in, we're not suggesting any extra data goes to HMRC. We're simply saying, you know, you have to put your bank interest on your tax return. Is it easier for the bank to send it in, or is it easier for the taxpayer? And we think it's probably easier for the bank to do it.
Yeah, absolutely right. I guess they've got the data. It's got to pop up in the right place and
Yes.
on the right person's record. Which
Absolutely,
is,
absolutely.
As you say, is the key bit. Thank you for that, Bill. That's a really good insight for something which I'm sure will unfold over the years ahead. Before we go to question, I've just got and finally for you, because the OTS recently issued a document on the potential moving of the tax year, which we all know and love as the 5th of April every year. Some commentators I saw thought it would be sacrilege to change the tax year from the 5th of April to anything else, which might be sensible. But you know, it's a rarely understood tax year end date. Those of us in tax all know the reasons. So, but could you let us know your thoughts on that before we go to Q&A?
Yes, of course. I mean, firstly, to say we're still working on our report. We aim to publish that sort of mid-September, I think. I think it's fairly easy to work out that it'd be much easier for everybody, particularly in an age of technology and accounting systems and so on, if we did things by reference to a calendar month end, or possibly the end of a calendar year. And so I think that is fairly straightforward to demonstrate. You just sort of think of all the reports that are done. You know, the bank's doing the bank interest, the investment manager drawing up details of the dividends on your investment account, for example. Anybody trying to do accounting for, you know, their rental property, or indeed for their self-employed business, you're never going to draw that up to the 5th of something or other. You're always going to draw it up to the end of the month. I mean, that's just the way normal life works. So it's much better to focus on all of that. I think what many people don't quite understand, and I hope our report will help show them, is the scale of the change that will involve for government systems. You know, HMRC systems are the biggest in government, and they're probably bigger than all the private sector systems you can think of. You know, bigger than a banking system, bigger than a pension company system, and that sort of thing. Some of these systems are legacy, which means really old, and changing them is not going to be easy. And obviously there's an upgrade process and a new system process in both public and private sector. And the cost of change in terms of time and everything would be really sort of something that would be difficult, would need quite a lot of planning to do. You know, if the government decided, well, just going to do this, it would not be capable of happening next year. So I think, you know, we'll probably say it's up for the government to think, does it want to make a change? We think there is an overall benefit of doing it, but the cost of change is significant. You would need a lot of planning to get there. And it may be best to do it when we have upgraded some of the systems that we're currently upgrading, both in the public and private sector more generally. So maybe not now, but in 5 years' time, something like that. And it's then going to take, you know, a number of years just to plan. Obviously, lots of bits of legislation will need to be changed. There's all the hard-coded systems. There's hopefully the more modern ones, which will be a little less hard-coded. There's government policies to think about. We could have either a sort of 9-month year, or we could have a 360-day year. What do you do about all of that, and bans and allowances and all that stuff? So it's actually a massive stuff to think of, and obviously is all the private sector systems to think of, and including things like weekly paid people, and we need to make sure that they don't lose some of their personal allowance in an unrealistic manner, just as for example.
No, thanks, Brad. It's a small question, but a big answer. Absolutely right. There is some support in the Q&A for
and I saw that, which is great.
Yeah, which I think is absolutely right. It aligns very well with international systems, and could certainly make that aspect of tax reporting easier.
Yes. Yes.
Right. So I'm going to move to a couple of questions. We don't have a huge amount of time, but I'll ask Chris a short question. One of the questions come in: would the panel agree that capital gains tax appears to be a significant barrier to the appropriate allocation of assets? And maybe that's around hanging on to assets rather than transfer them around. If you have a short answer to that at all, Chris.
I think it can be. I've certainly seen clients who are reluctant to make, say, the appropriate investment decisions because they've got a single asset which is sat on a very large gain. Ultimately, it's the old cliche, isn't it? You shouldn't let the tax tail wag the investment dog. It doesn't make any sense to sit on an inappropriate investment asset, even if it's standing on a large gain. If ultimately it doesn't, you should be talking to your financial advisors and trying to encourage people to get into that sort of diversified portfolio. But yeah, certainly it can be a barrier. But there are also ways that you can potentially mitigate the tax cost, if you like. Potentially some investments qualify for deferrals or rolling over of CGT reliefs as well. So that can help with the potential pain, I guess.
Yeah, absolutely. Thank you for that, Chris. Question for Bill. Somebody's asking, I understand the Chancellor has a statutory obligation to reply to the proposals in the OTS reports. Do you have any view on when the Chancellor might make that response, and how substantive the response might be to either of them?
Well, firstly, I have no clue what the Chancellor will say, but you're absolutely right. The Chancellor does have a statutory obligation to do it. Unfortunately, when they put it in, they didn't put a time limit, which is a bit of a snag. But usually the responses are given at a so-called fiscal event, so at a budget or a tax day. The response on the first inheritance tax report, for example, came on tax day, which was when a lot of detailed tax documents were released after the last budget. So maybe the Chancellor will reply in the autumn budget to where they'd like to go with all of this. Now, I should say, we are never consulted once something goes from us into the Treasury and to the Chancellor, and so I can give you no sense as to what direction would be.
I think that's
obviously
really
if I could, I wouldn't be able to, so it wouldn't be allowed to. So
I think that's really the question.
Either way.
Yeah, I think we need to know what the answer to all of those recommendations are. But thank you for that, Bill. One final question in the last sort of minute or so, Elaine. Question is why can't digital VAT and digital income tax all happen at the same time for those over 10,000 rather than April 22 and April 23, so that self-employed and partnerships can ensure software they get is compatible for everything. I suspect we already see maybe it's too much to do it all at once, or maybe it would be easy. I don't know. What do you think?
I completely agree, Gary. I think we've had VAT in for a year or so now. That's progressing and opening up as to a wider audience. I think we're bracing ourselves, and I would think 2023 is quick enough and it'll come around fast enough for individuals to be ready. It hasn't been widely advertised. I suspect if you asked a self-employed person earning just over £10,000 to explain making tax digital, it would be very difficult. So we need a lot of education to make sure that people are ready, and we need the time to do that.
Brilliant, thank you. Well, our time is up, so we've reached 1 hour. A really big thank you to Bill Dodwell from the OTS for joining us today, providing some really great insights into the reviews that they've undertaken. And personally, Bill, I think the work that you and the OTS do is vital to us being given the opportunity to input into very early stage thinking by government, and could mean that they avoid some of the mistakes caused by rushed legislation. Possibly. Thank you for joining us, Bill. And a big thank you to my fellow partners, Chris and Elaine, for your perspectives from working with clients every day. It's great that you could share your views and insight with us too. Finally, a very big thank you to all of you for joining our webinar today. If you have any questions on any of the topics raised and some other questions which we weren't able to answer, please feel free to contact any of us or speak to your usual RSM contact. Thank you very much, everyone.
Thank you.
Good afternoon.
Thanks. Bye.
Bye.
Cheers. Thank you. Bye-bye.